Hi everyone, today we're going to do a bit of an education video and we're going to talk about how to avoid investing into a bad stock or a bad company. So today we're going to take a look at this. Before we get stuck into the video, I released a video yesterday talking about PayPal and PayPal potentially acquiring Pinterest, and oh my days, the video did absolutely shocking. I'll tell you something, I won't be talking about that anytime soon, and maybe we need to work on making the videos a bit more clickbaity. But anyway, we'll get stuck onto this, how to avoid buying or investing into a bad stock or a bad company. So the reason I really came up with this video is because a few days ago I started talking about a very good food company, and I basically went on that video to say the stock was, or the company was, very terrible, and it's probably one of the worst stocks, the worst stock I've seen this year, and one of the worst stocks I've ever seen. And it was a real surprise to me. Like, there's always going to be people that do invest in the company, but it was a real surprise to me to see the amount of people that were investing in that company and the amount of people that were sticking up for that company and going, yeah, it's a really good investment. And I was like, what? Like, fair enough, there's a couple of things that you can debate over a stock or in a company that you see on the financials, and you think, okay, we might let that one go, we'll leave that up for debate. But there was so many red flags with that stock and so many things wrong with it that I thought, okay, we need to make a video addressing this and looking at what is a bad investment to make into a certain stock. So we're going to go through this today, so I hope it is useful. So first of all, two key things, these kind of tying together, so we'll be probably doing a lot of this together, which is earnings and revenue. Earnings and revenue are make or break on investment, because when you invest into when you make your investment into this stock, what is going to be the key drivers for you to make money? Because that's why we do it. We do it to make money. So you want to make money on this investment. The reason why you're going to make money on this investment is because the company does well, and if it improves its earnings, if it improves its revenue, and they go up, what you'll see is that share price over a long period of time move in line with it. So if you have a company that is losing revenue, or revenue is decreasing, you probably see that stock go down, and eventually if you see earnings go down, that will also mean the stock goes down. So at some point you need earnings or revenue to move in the right direction over a long period of time. Now, what's happened quite recently is a lot of people have kind of ignored this one, and earnings haven't really been focused on that much. What happens now is a lot of people will focus on the revenue and only look at the revenue, and people will forget that earnings is, at the end of the day, is really important. There's periods of time where you justify, okay, it's making these sort of investments, but at some point a company has to have that vision of making profit. If it never makes profit, it won't be successful in the long term and it will go bankrupt. So you have to have the vision there, that where is this going to start making profit? A lot of people say, oh, the likes of Tesla, Shopify, Square, all them stocks have done absolutely amazing over the last kind of few years. But the reason why is, sure, they might have had crazy revenue growth, but what did they all have in long term? You had the vision of how they're going to start making profit. And eventually what happened with those stocks is that you had the share price went up because it had the revenue, but then people were like, are they going to start making profit? And then they made profit, and then the share price went up crazy amounts again, because we can appreciate the revenue, but at some point the questions will be raised, are they going to start making money? The worst case, what you want to see really is, if you have a stock that's making a lot of revenue and it goes up like this, you want to see the revenue looking like that. And what you want to see eventually is them earnings kind of, even if they're losing money, okay, it's moving up in the right direction with it, and eventually the crossover happens and we start making profit as well as revenue going up. That's what you want to see over a long-term investment, especially on the growth stock side of it. Obviously, if you invest in a lot more later, mature companies, then that crossover would have already happened. You probably have a company that already is making profit and will carry on growing those revenue and profits, and you'll do well. But what happens here is, quite often people invest in a lot of growth companies, and at the end of the day, that's what we need. We need earnings, revenues to do well, and the stock price goes up. Quite often people make it sound very complicated, but it's quite easy when you think of it from that point of view. And what people will do is they'll look at a company that's growing revenue at a huge amount. So let's say this is the revenue, and it goes up like this. But what's happening on the bottom line is a company is going like this, and then every time they keep increasing their revenue, their earnings keep going down and down and down, and eventually you end up with a big massive gap like this. And people think, oh, it's okay, it's growing revenue. But at the same time, you're losing a ton of money, and that's going to cause a lot of problems, because at some point that needs to move in the right direction. If it doesn't move in the right direction, that's going to cause a lot of problems. And quite often people just stare at the revenue and go, oh, look, the revenue is growing so much. But that company has to have vision to get to profitability. If it doesn't have vision to get profitability, this is going to cause a lot of problems. And people ignore that. To put it in a simple context, if If I went out on the high street and I bought some PlayStation 5s, if I bought 2 PlayStation 5s for 500 and I sold them for 400, then I'd lose money. But if I went around going, oh, look, I've made, today I've done, 800 in sales, look how much my sales are. It doesn't matter, I've just lost £200 overall because I've sold them at a loss. And it's exactly the same thing. And people, once again, justify it this time, they'll go buy eight PlayStations, sell 8, and go, look at the sales, I've made even more today, but I've lost even more money. You wouldn't do that in real life, and it's the same for these sort of stocks and these companies. You can justify it in the long term for a couple of things, but realistically you can't keep going through that process of making that gap wider and wider. And what happens quite often, and people aren't aware to this, is that you can have a development stage, but that development stage can't go on for a very long time. And quite often with a lot of these businesses or stocks, if this is happening, you as an investor, you can probably wait to find that mature, that if they are going to start moving in the right direction. Quite often people will gamble at this sort of stage on an investment, and then it keeps going like this, when realistically you could afford to wait for it to kind of just start moving in the right direction slightly, and you won't take on that much risk or have that risk of getting burnt. And if it carries on doing this, people ignore the earnings, and then what happens is they look at the balance sheet and then go, oh, that's not good. And that's what happens, because if this carries on, then this causes a massive problem for the balance sheet. Because if you have a stock or a company, you just keep staring at that revenue and not focusing on this is going to cause problems. Because if this isn't growing, or this is decreasing, or if they're losing money and they lose even more money, this is going to make this even worse. Because what's going to happen there is you'll have a balance sheet that has debt on. And you don't want to be buying, you want to have a good balance sheet when you make an investment. You want to have a solid balance sheet. You don't want to have a company that has debt on it or has to take more debt on it, because that's going to cause more problems. If they need to take more debt on, it's going to be a higher interest rate. If we had one of the things you want to always do is you want to buy a stock or an investment that you go, if they were to have zero revenue for a year, would that company be okay? And we used to say that previously, that if something went wrong inside the company or there was a product that went wrong, that's what you used to say prior to 2020. But now we can say one that took us all by surprise is that if there was a pandemic again, you've seen it. Some stocks will not be able to operate, and you want to look at the balance sheet and go, are they okay from that point of view? And if they are not okay from that point of view and they carry on losing that money, that's going to cause problems, which you don't want. That's what you want to look at. So you want to have a healthy balance sheet, and if you don't have a healthy balance sheet, that's going to cause problems. It's going to cause problems if you want to raise money. That they'll obviously have higher interest rates, and if they carry on losing money, then it's going to make it worse. They're going to take on more debt, more higher interest debt, or the other option is they dilute you as a shareholder. And people overlook this. If you had owned 1/10 of the company, and then they put, over the course of a 2-year period, they double the amount of shares outstanding by double it up, then your shares that from owning 1/10 of the company, double the shares outstanding, you own now 1/20 of the company. And that's obviously not a situation you want to get in as well. And people just kind of quite often overlook a lot of share offerings, but you as a shareholder are slowly getting diluted, which you don't want either. And quite often this is what people do. They overlook quite a silent killer on a lot of these stocks and don't really appreciate them earnings and where that long-term goal is. And once again, this also then starts affecting the balance sheet. And this is what we had with a company like a very good food company, a terrible stock, because every time earnings kept going up, you kept losing more and more money. What's that causing? Well, they're getting more debt on the balance sheet, they're getting debt that's on a higher interest rate, they're also getting diluting shareholders, so now you're owning less of the company. It's just a horrible situation, and as you as an investor, you don't want to be in that situation. It might turn out to be okay, but you can at least wait a couple more years until everything starts moving in the right direction. Why take that risk now? And so I think that's obviously 3 things that tie in with each other. The next thing is management. Management can make or break an investment. So like a management on a very good food company is a terrible management team. Obviously the earning, you don't want to be in a position where you have losing more money as the revenue goes up, and then that's turning the company into a horrible balance sheet. But you've got to question management. Management are you are putting your money into a company or a stock. the management are basically controlling your investment. So you have to kind of be very critical of them and make sure they're making the best decisions for that investment, because they have your money. And like a bad management here for a very good food company, you look at this here and you think, okay, they're already losing a ton on earnings, so they want to make sure they don't carry on doing this and losing more and more money. You want that to stop going down, really. And what the management do? They go and pay influencers to promote the stock price. Now, you as an investor want to be criticising that and going, why are you using funds of the company I own to go promote the stock price? This has no benefit for me as a shareholder. Why would you want that to happen? You want to see in the long term management focusing on growing this and this, because that's where you're going to make the money as a shareholder. Promoting the share price in the short term, what is the point on that? There's no point. It has no benefit to the company. And all that's doing is making this even worse. And that would be management that you question why you're making that decision. Make investments that are going to help this in the long term, not something that's going to help the share price in the short term. And then you have to look at that point of view and go, why are they promoting the share price in the short term? Are they trying to get the share price up to raise capital? But instead of focusing on that, why don't we just make sure we're not losing as much money and we're growing our revenue? Or are they potentially benefiting themselves and getting that share price up so they can release shares and they're actually working in their best interest rather than you as a shareholder? So you want to be looking at what management are doing. You want to be questioning the decisions they're making. And I guess the last thing which can make or break an investment, which is valuation. You don't want to pay obviously too much for an investment. So what a few people were doing here, and it's not as bad now, but what people were doing is people were paying for a very good food company, for example, were paying 1 billion for this investment. This company was making 8 million, and they were losing 30 million. So they're willing to pay 1 billion for a company that makes 8 million and loses 30 million. I mean, when you're willing to pay that sort of valuation for that sort of company, you're not putting the odds in your favour. That's the big thing. You're definitely not going to help yourself. Now, I think around about now it's down like 200 million. Which is obviously a lot better. It's one fifth of what it was previously, but that's just a reality check. I mean, that's probably still really expensive for a company to be paying for a company that makes 8 million and loses 30 million, in my opinion. But just to put that in context, people are willing to pay 5x that. So you don't want to be paying for a valuation that's too crazy. That's something that can obviously hurt you as well. You want to make sure you are picking up a company that's probably at least fair value. Ideally, you want to be buying something that's probably undervalued. But yeah, those are 5 things that are really important to avoid making a bad investment or investing into a bad stock. So hope the video was useful. If it was, hit the like button. If you're new, subscribe, and I'll see you next video.